Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG recap. So up on the screen, you can see another week of low rates. Mortgage rates continue to hover near 14-month lows. Little bit of we came a little bit off the best levels last week, but again, just another great week. And what I'd like to share with you, what I think is happening right now as we are now right into the spring home buying season. I'll put a bunch of lists here, what I call a Goldilocks scenario, right? Goldilocks, where not too hot, not too cold, kind of just right. And that's what's happening in the housing market. And so there's a list of things that I think are going to really make this spring housing market likely the best in the last couple of years. When we look at the last couple of years, there were affordability issues. There was low housing inventory. This year's a bit different. So I'm going to run through these. Number one, we know the Fed is not going to raise rates in 2019. They said that. In fact, there's a better chance of a Fed rate cut in 2019 than a hike. And that's a big change from where we were just a few months ago. Number two, inflation is subdued. Inflation is not a threat. If inflation doesn't tick higher, long-term rates like mortgages can't tick higher. Number three, home prices are moderating. The gains are moderating. This is a big deal because this goes right to the affordability piece. Home prices a few years back were running at 10, 15% year over year, and and wages were only rising at 2%. And so now they're much closer. Home prices are gaining at 4 to 5%. Wages are closer to 4%. So much more of an equilibrium. 5, the labor market remains solid. I mean, we are seeing unemployment at 50-year lows. Wages are rising because of that tight labor market. People buy homes because they have a job, not because interest rates are low. So now you have the best of both. Another one that doesn't get a lot of play, Europe can't get out of its own way. We've been talking a lot about how Europe has been struggling. And with their economy struggling, that makes their bond yields low, real low. And there's only a couple of big bond markets on the planet that investors go to. Germany, I think of, Japan. Those yields are 0 to negative. So seeing the 10-year note at 2.5% is pretty darn juicy. And so there's going to be a nice, that's going to keep mortgage rates at low levels thanks to what's going on in Europe. Next, stock market near all-time highs. That has a positive wealth effect. People feel wealthy, even if it's locked up in 401ks and IRAs, they feel wealthy. They're more apt to buy. And believe me, there's a wealth effect happening right now. People feel really good, which goes to the next one. Consumer confidence is rising again. Why? Pretty much for a lot of these factors. The Fed's out of the way, stocks are rising, interest rates are low, the prospect of getting a job feels good. And then finally, home loan rates sit now at 14-month lows for a lot of the reasons that we just mentioned. And there's no pressure to put them up much lower, I should say. So when you look over the next foreseeable future, there's a difficulty of seeing rates get much better, but at the same time, it's really difficult to see them much higher. We have this kind of Goldilocks scenario as we move into this, housing market. And it's not just for spring housing. This is for the foreseeable future. So I think it's a really good story that you need to be sharing with, not just clients, but also your partners. And when we take a look at the chart, again, this is right here, this peak from last week, that was a 14-month high. And we're a little bit off of it, but still an unbelievable scenario. I hope this finds you well. Have yourself a great weekend. We'll be back at it soon. Bye for now.